Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, both new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So, hey, Mike, hey, thanks for carving out some time. I know you're in the process of some city meetings today. So thanks a lot for carving out some time for Accelerated Investor. Thanks for joining me.
Yeah, absolutely. Thanks for having me. I appreciate it.
You bet, Mike. So let's talk about that. Like, I usually love to talk about current events, especially with somebody kind of new that I'm just getting to know. You mentioned we're getting ready for the show about some new construction that you're working on. So what are some projects and things that you're passionate for that you're working on right now that you can tell our audience about?
Sure. We have about 500 units, mostly multifamily units under development here in the Austin or greater Austin area, Texas. That's kind of our focus is Central Texas and the surrounding areas. We just see as just huge growth corridors here. We were meeting with the city of Taylor, and if you've read anything about Taylor, Texas over the past year, Samsung announced their $17 billion acquisition development that they're doing. It's a chip manufacturing plant that they're putting out there, which will bring about 3,000 or 4,000 jobs to the market. And they actually announced an addition to that, which be another $10 billion addition that they're going to do. So Samsung's heavily invested in Texas, and in this area, we have an 84 unit townhome development that we're doing out there that we actually bought the dirt on a year before Samsung announced they're coming. And the development should be complete about 6 months before Samsung completes their development. So we're kind of right in time. That was we hit the market at the right time there. And then we have another project here in Leander, Texas. It's 84 units, multifamily, and 10,000 square feet of commercial. So it's a smaller mixed use still. And we are close to getting permits done on that. We've taken that from raw dirt through the rezoning process to getting it fully entitled with the city so that we're able to get a construction loan and build it. We've raised the money for it, so we're ready to rock and roll there.
Nice.
And then a few other multifamily deals that are under process that are a little bit further behind. We have one that's actually close to being to lease up. So that's our furthest project along at this point. It's a multifamily deal here in Leander. So we've got all kinds of new construction keeping us busy, and a few other acquisitions and you know, value add and yield plays that we're doing along the way. So
got it. Why move? Because I imagine you did the yield plays and the value add stuff first. At least that's my guess.
Yeah. Sure.
What led you to new construction? I asked that for selfish reasons because we own a value add portfolio, and we're about to build a 11, 12 story tower that's about 100 units, kind of an infill deal in a really hot suburb. So tell me about your jump into new construction. What did you learn about that? Some of the challenges, why did you do that? Why'd you go that route?
I think it's the numbers just led us there. We were able to flip some of our old value add stuff in 2018 and 2019 and able to get a good chunk of money, which you definitely need in development. And it just made sense as the replacement costs for units were lower than what you could purchase them at. You know, we're building stuff in Austin, you know, between 160 just on construction costs, 160, 175 a door. And, you know, brand new Class A stuff is still trading in 250, 265 a door here. So there's just enough meat on the bone where it makes sense that if you can get it through the entitlement process and build it and complete it and occupy it, that you'll make some money. You know, there's been a little bit of relief in the cap rates. You know, we've seen some decompression of those cap rates over the past few months because of interest rates, which I think we're just getting back to a bit more of what a reality actually is. I've been saying for the past 2 years that these interest rates are artificially low. It's to stimulate the economy through a downturn because of COVID, and it certainly did. And now that we're experiencing inflation, the one way to hedge that is to raise interest rates, which they've done. And you're just going to see the market slow because of that. So I think we're getting back to reality here with where cap rates should be, and you should be able to get some yield on some deals here coming up. And we're heading to a good spot, I think.
I'm curious. I love the where you're going with that. I'm curious because cap rates tend to lag the market, right? The Federal Reserve can change interest rates in a heartbeat. The 10-year Treasury can change the cost of permanent financing or bank financing in a heartbeat.
Yep.
Cap rates usually lag, right? 3, 6, 9 months, because there's deals that were under contract 4 months ago that are just trading now.
And those are falling out of contract, and those are being retraded left and right. I mean, people walking away from earnest money just because deals don't pencil. And people will not buy when they can't have at least some yield or the promise of some yield, because banks won't lend. These underwriters are tightening up the belts, and they're looking at it and saying, guys, you've got to be a bit more realistic.
Right. And how has that changed your model? What adjustments, what kind of flexibility you had to have?
I think we bought far fewer deals in the past 3 years than we have the past 8. We were buying, one year we bought 2,000 units. We were very aggressive. We closed the portfolio of 8 properties in a year. And we were up to 5,000 units under ownership. I mean, we had all kinds of deals coming, but we felt really confident in our country's leadership at that point. We felt really confident in the economy, and I think most people in business felt the same way. So people were spending, people were selling properties. The market was great. Our strategies changed a bit to where on current acquisitions, we really only buy for cash flow. So I'm no longer looking at, I do look at value add because that's naturally where I go, where can I create value and increase the NOI. But I'm looking for going in cash flow. Is that debt service coverage ratio just barely where it needs to be, or do we have some cushion? And that has forced us to buy fewer deals, but all of our deals that we own right now are very comfortable and cash flowing very well. And
I think there's a time to take some of that risk, right? And usually money is cheaper, and you feel like the leadership is in support of capitalism. It's time to do that. And another time is to kind of pull back and kind of wait to see what happens.
Right.
One of the things that I teach is this kind of 9 traits of elite entrepreneurs. And number 1 is to invest for cash flow now. Right. And not invest for cash flow 3 years from now when you could execute a huge value add play. And then it starts to cash flow down the road. We've certainly done those deals. No question about it. Even today, waiting for some cap rates to get more realistic, especially in line with the cost of debt, so that the deal cash flow. I have a deal that we're actually closing in 2 days. When I penciled it, it was cash flow break even after paying the expenses, the debt service, and a pref return to investors. It was perfect. Now, because the cost of debt, the 10-year Treasury has gone up in the last 60 days. Now it's going to bleed about $35,000 a year. It's not a huge bleed. It's not a huge deal. It's only $6.5 million purchase. So we're going to buy it anyway. But that's a real example, right? And if you buy a $30 million deal versus then you 5x everything I just talked about. Now you're bleeding a pretty substantial amount of cash. That's what's happened in the last 60 to 90 days.
Right. Yeah. We have a relationship with a seller in Tennessee, and we bought a deal from him before, and he has a big project, really, really nice Class A project that we're trying to go after. And he had it under contract with some guys, and they failed to perform because interest rates were hiking. So I think what you're seeing is a turn of these sellers that are saying, okay, what's realistic now? I've had some deals fall out of contract. Where's my strike price? And how do I get there? So I think that the lag that you were talking about with cap rates is really seller driven. it's broker driven, and it really, I think all of those players, the brokers I've spoken to, they're starting to convince these sellers like, hey, these cap rates, they need to go up a little bit to get people comfortable, especially banks. Because if the bank says no, then, there you go. The rubber meets the road there.
Right.
Or your leverage goes to, 50%. And, who wants to put up 50% on the cap stack? Not many investors.
Yeah.
So there's fewer doors trading hands at that point. Right.
Yeah, no doubt. Help me understand, Mike, because I'm in Cleveland, Ohio, and Columbus, which it's almost like a gateway market now. It's very much operates like the Sun Belt. But what's it like operating in Austin? I just am, everyone here is like, wow, Austin and Dallas and these, Denver, these kind of gateway markets with this incredible growth. I'm just curious to hear from your just, experience. What's it like? What's really happening there?
It's insane. I mean, you have a city that, has stayed small for a long time. Austin has prided itself on being small. And when you have the big boys come in like Tesla and Samsung and Dell, and who's been here for years, or Google, who are making these billions and billions of Apple, just built the second campus here, 15,000 employees. I mean, they're making a statement that, hey, Texas is a good place to do business. Mm-hmm. And Austin is convenient for those California companies because, let's just shoot each other straight here. Most of these people on the West Coast, are, blue, and that's how they vote. And they love that Austin kind of feels a little bit like home. Mm-hmm. It's a blue city it's like the blue island in a red ocean. Sure. So, it kind of gives them the warm and fuzzies that they can feel at home here and still get the benefits of being in a red state. Mm-hmm. So I really think that we're just going to continue to see rent growth and values grow. We've seen some retraction in the residential market. There's, people just can't make sense of, huge value increase with a huge interest rate increase. It just doesn't work. So those are coming down. But I think with rental growth, especially with the hiking interest rates, I just think that we're going to continue to see rent growth. You have to, because the demand is just so heavy.
And so affordable housing is so little. And like the ability for builders to build new single family homes is they're paying more for debt. That we were already like 1 million units short per year. We needed like 2.1, 2.2 million units built to get to demand. Builders were only building 1.2, 1.3 million. So we're already 900,000 units short. And now because debt's going up, they're actually retracting and pulling back on the number they're building. So it makes the gap wider, which means if you're an apartment investor, rents have to go up because there's nowhere to live. Yeah,
they have to. So how I'm looking at the market and what's my insight to it, we saw a 30% rent increase from 21 to 2022. And this year, probably another 15 to 20%. So you're looking at nearly a 50% increase in rents. It's forcing a lot of people to move out of the city. They're going to the suburbs, where fortunately that's where I'm building. Glenn and I 2.5 years ago sat down and said, we need to get in front of the growth. Glenn used to work for one of the founders of Marcus Millichap. He had a subsidiary company that Glenn worked for in asset management. And he always used to preach, get in front of the growth, get in front of the growth, get in front of the growth. And that's what we've done. Taylor, Liberty Hill, Leander, these suburbs that are all around they're just growing by virtue of the city of Austin growing. And we've been able to we've been the catch basin for a lot of these people fleeing the huge rental increases in Austin. But I mean, I really think that this market isn't going to stop growing until it's like LA. I think that that's where we're heading. We're heading for, the cap rates, LACs, which we've already experienced. We saw 2.5, 2.7 cap deals trading in Austin. And I think we're looking at $3,000 or $4,000 a month for a 2-bedroom, 2-bath in Austin. So
wow. Unbelievable. You're going to have a Skid Row there too.
Oh, we already do. Yeah, that whole, well, it got really bad, and that directly affected one of our deals in Austin. The way the city of Austin operates, it operates with the city council. So the mayor has one vote of like 10 or 11 votes. So they came in and they voted to do away with the ban on public camping. And that happened 3 years ago. And basically everybody that goes to the city of Austin on the weekends to eat or go to concerts, they just stopped going, because it was like Seattle or LA, where it's like you're dodging needles and whatever. It was really bad. And they actually revoked that, and they now don't allow public camping. So
in town for the weekend, why not just bring your own camp, your own tent?
Well, and these, with some of these people that are there, find a place for them to live. Let's use we can write $40 billion to Ukraine. Certainly we can find housing for these individuals that are on hard times, and that's to the credit of City of Austin. That's what they've done. They've gone and bought old hotels, and they've renovated them, and they've turned those into some, temporary housing for folks that are falling on hard times. So anyways,
that hard. It's tough to manage it for everybody, right?
Oh yeah. These big cities are just magnets too. So it is what it is. So
are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast.
Yeah, Mike, you mentioned getting in front of the growth. So just peel back the onion on that for me a little bit. Like, what strategies or what are you looking at? What data, what statistics, what news, what can someone do if they're in a different market? Let's say it's not Austin. Let's say it's, pick one, Raleigh, North Carolina, whatever. And they think that there's growth happening.
Yeah.
I want to get in front of the growth. Is there a couple things, a checklist or something that you can look at, some specific data points that you would say, I would reference back to this, and this to see where the growth is going? Is there any guidance around that?
Sure. Absolutely. I mean, you can pull your standard reports and see where population trends are going. And we all know that residential always precedes commercial. So, if you're a commercial builder and you want to build some retail or something like that, if they're building a 10,000 multifamily units in an area, that's probably a good place to go and put some commercial. Sure. But, some of the metrics I look at, and they may be silly to some people, but they sure do mean a lot to me, is I like to look at some of the retail lots some of the lots that are bought by big box retail people. Like locally, HEB is a really, really nice grocery store that people love here. And so if HEB's bought land and they're planning to develop there, I think, okay, they hire people to do projections and growth projections. They talk with every municipality and city. They know where the growth is going, or else they're not buying dirt there, right? So, or like Starbucks, for example. I mean, some of these, Chick-fil-A, there's some of these chain restaurants that do so much market research to see where growth is going, that if you can kind of piggyback off of, okay, if they're willing to put their money here and open a restaurant or Starbucks, there's a reason why, so it's kind of silly, but if you can look and find those folks, it makes sense. The other thing that I look at is the number of jobs coming to a market, right? Because you want people that can pay their rent, obviously. Yeah. So, if you have like us here, we have an endless amount of jobs, so it makes it a bit easier. If I'm in Raleigh, North Carolina, what economic factors do you have that are showing positive growth? I'll give you an example that's, not here. We look a lot in like the Bowling Green, the Clarksville, the Nashville area, and we look at the economic drivers there too, right? In Bowling Green, they have a university, Western Kentucky. They also have the largest textile industry in the States there, Hanes and jerseys, and all of those things are manufactured right there in Bowling Green, Kentucky. I have to ask myself, do I see that industry growing or do I see it shrinking? What's going to happen? Are universities growing or are they shrinking? And you have to ask yourselves those types of questions and look and see, we'll meet with the Chamber of Commerce and try and pick their brains, local business owners. Hey, what can you tell me about the growth here? Who's coming here? What jobs can we see in the future, and that type of thing. So it's a lot of just data and then also building relationships with folks that know what's going on. The city will tell you what's coming. I was in the meeting with the city of Taylor today, and I got a contact given to me that's their direct contact with Samsung. And I'm going to call this guy and I'm going to offer him to buy our project from us so he has housing for his employees that are going to be there, so it's relationships too, it's trying to, get in there and meet the right people in the city that know what's going on, who's the city planner or city manager, call them, talk with them, to get this in.
The growth plan for the city, they're going to share that data. It's not like it's
not a secret.
It's not a secret.
Yeah.
Like this is
not proprietary information. Yeah.
Are you part of the plan? Are you part of the help? Are you part of the progress?
Yeah.
And you can set up the right to know that information regardless.
Yeah. You can set up a meeting with the city planner or one of his, employees or whatever. And you can sit down with them and say, hey, look, I'm looking at this lot of land and I'm really wanting to build multifamily there. I know that the city needs some multifamily. You can look at absorption rates. If you have access to CoStar, you can pull absorption rates in the city and be like, you guys need 1,000 units and you only have 200 under construction. I want to help the city get there. Is this part of every city will have a map to growth if they plan on growing, right? So they'll say, well, that's not really the growth corridor we had envisioned. We kind of more envisioned along this street here having multifamily. And you're like, okay, maybe I'll go over here and look for dirt, right? They'll tell you where they want things built. A city that's planning to grow should have a plan for growth. Yeah. So you can get a lot of that detail from them without doing too much work yourself. It's just asking the questions and being willing to sit in the room with them,
Yeah, that's great, Mike. I wasn't planning on going this route with this particular interview, but I'm really glad that we did because, I got to learn a little bit more about Austin and a little bit about being in one of those gateway super growth markets. And learn a lot more about, looking for dirt and looking for new construction, looking for build. We had a great conversation around cap rates and interest rates. So really fantastic stuff and great content for our people. Mike, if they wanted to reach out to you, learn more about you in this just short 20-minute interview, we don't have time to cover everything. Where can our group go to engage with you, learn from you, invest with you?
Our website, obsidiancapitalco.com. Or you can just email me, mike@obsidiancapitalco.com. I'm happy to talk. If you're an investor, I'd love to, show you what we have in the pipeline. If you're just curious if you're a developer, an aspiring developer or entrepreneur, I'd love to chat. Happy to have you to our office here. If you're in the Austin area, come on by and see us. So we'd love to have anybody by. So
fantastic. Awesome stuff today, Mike. Listen, thanks for carving out a few minutes for us and joining me on Accelerated Investor.
Absolutely. Thank you for having me.
You were just listening to the Accelerated Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build the AI community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at www.joshcantwellcoaching.com.